protection in the portfolio, those puts are going to be costing us, say, 3 to 4% even per year. That's where the return driver diversifier comes in. That's structured to return over time that 3 to 4% per year. So it's intended to pay for the cost of that put.
Thank you so much for tuning into Journey with Christian D. Evans podcast. I'm your host, Christian D. Evans. Jackass Investing. Don't do it. Profit from it. That's the author of this book. We are so excited about having this guest on. Let me just share with you a little bit. He launched Brandywine Asset Management, investment management firm in 1982. So you think he went out through some ups and downs in the market? Yes, he has. Brandywine has extensive practical experience with wealth management, alternative investments, equities, venture investing, entrepreneurship, real estate development, and residential rentals and construction. This man is entering his 5th decade of managing Brandywine Asset Management, which offers the Brandywine Protected Funds. These funds solve sequence of return, which we're going to be unpacking today. So make sure you listen to this. It's actually a very cool strategy. Risk for investors in retirement plans and limited downside equity market risks. Brandywine's approach is based on the innovation of risk replacement, which incorporates the return-driven based methodology described in his best-selling book, Jackass Investing, Don't Do It, Profit From It. Please welcome the managing partner and CEO of Brandywine Asset Management, my friend, the one and only Mike Dever. How you doing today, Mike?
Very good. Thank you, Christian.
Man, I'm looking forward to this conversation. But before we dive into this, I really want to, because you've been in this industry for many, many years now, and you have found different verticals, like we were talking about. You kind of refocusing a little bit on, like you mentioned, a little bit about some things we're going to be talking about, kind of the hedging and kind of mitigating the risk. But Mike, I want to ask you in regards to all your clients that you work with. I understand human psychology and our own biases get in our own way. So, with your clients, how do you ensure that you have the right boundaries, the right systems, the right protections in place for them so that they don't actively constantly invest and so that they're constantly making sure that their biases and the human psychology is out of the way and you guys stick with the plan, even with tumultuous times like we're seeing right now?
It's difficult to do that because every individual is different. We find that there's some people who are, if they start asking as soon as they invest, how we doing, what's their performance look like, and they're calling you every week, they're probably not going to be a good investor. If it's somebody that just sort of gives you the money and they disappear for a while, that's usually a good sign. And you see the studies in this over the years that the less people trade, the better they do. We did a study early on. Goes back to the 1990s on our investors up to that point. And we had a fund at that point that they'd been in that had averaged right around 20% annualized returns. And we did an analysis on the investors' tenure in the funds versus their performance. And the people that were in there for less than a year actually lost money. So this is something that compounded at 20% annually over a decade. And people that were in there for 1 year lost money because they got in, they hit a bad spell, they got out. It took until about 3 years before people were starting to hit the average return of the fund. And that's because they tend to pull out when it's down. And that's just the emotion that's there. You can't change that. I don't see that. It's very difficult. Some people are just going to do that, and some people are going to stay in for the longer haul.
Yeah, and that's kind of what I was asking is like because we understand, there's been a lot of research. Those that are just more like passive, where they don't actively, buy and sell and buy and sell, those that are more passive, they tend to outperform those that are more, buying and selling kind of approach. And Mike, I want to kind of dive right into a little bit of your methodology. You guys talk about, protected funds. These funds solve sequence of return. Help us understand, and my audience understand that verbiage and how you guys came across this kind of approach.
Sequence and return risk is something that really comes out of the retirement industry and the jargon that they use, essentially meaning that if you're retiring, say this year, it's going to be what you have to invest and what you have to spend is dependent on the sequence of the returns that you're going to get over the next 10 years. If we have a spell like we had in the 2000s, where the market sells off dramatically and you're withdrawing money the whole time, you're being penalized for that. Whereas if you're not taking money out, if you're in the younger accumulation phase, those periods can be really good for you because you're accumulating assets at a lower value and a lower price. So maybe you're taking your money out, they're substantially higher. So the sequence of the returns that you earn in your portfolio significantly impact the amount of money you have either to live on in retirement or to invest, to continue to invest with. The problem you have with most risk investments like the stock market is that you're going to have significant periods of loss. And something like the 2000s, for example, or like we just had over the last year, where people might lose 50% or 30% of their money. What we're trying to do is create products that smooth those returns. So those risks aren't as great, so they're not as significant if you are in a position where you're needing to take money out of your portfolio in retirement, or you're near the end stage of saving for retirement, where you can't really stomach a huge loss. Typically, people have addressed that by moving money out of riskier assets into what they consider to be less risky. Bonds, for example, which we know aren't necessarily less risky. What we try to do is protect the downside through option strategies, so that you end up smoothing returns.
How does that work exactly? What does that vehicle look like to ensure that? Because, like you mentioned, I think a lot of our audience they get that conceptually, but they want to say, okay, what does that vehicle look like to ensure that okay, long term, when you're whether you're getting to retirement, whether you just want to obviously anticipate that maybe 10, 15 years down the road and allocate your resources accordingly. What does that look like, Mike?
Yeah, so what we have is we developed this concept, this innovation of risk replacement. And what that means is that we have three constituents to the funds. The underlying beta exposure could be the S&P 500, it could be EAFE index, any exposure that people might just buy an ETF and own that. But then we protect that by buying put options that are generally near the money, moderately dated, 6 months, a year out, that if the market starts to fall, they'll protect the downside. There's a cost to that. So what we do then is we layer in what we refer to as our return driver diversifier. That's an internal portfolio that trades a broadly diversified group of markets and strategies that is intended and structured to pay for the cost of that put protection over time. So now if you've got the put protection being paid for, then the underlying beta is free to run up and down with that protection, but you're not impairing the overall upside performance. And the net result then from that is if you're able to take a downside from 30% loss to a 20% loss, for example, now when you're recovering, the same recovery return will generate new high profits, for example, if you're up 50%, 40%, rather than just getting you back to even. And so the whole concept is that you've replaced the risk of owning that underlying beta by offsetting it with the put options and replacing it with this other return driver diversifier portfolio, which is more broadly diversified and of lower risk than the underlying beta. It's risk replacement.
So with that being said, I would you mentioned a few things here. I want to kind of reiterate. I would imagine there are certain criteria that you guys make sure you follow to ensure that that put option is somewhat tolerating that position. And what I mean by that is you guys say 6 to 12 months. You're not pushing that out to like 24 months. And then what other things are you looking at and say, hey, if this goes up, 2 or 3 points, whatever that looks like, then that's where you say, okay, we're going to go ahead and readjust this or readjust our positioning. Explain that a little bit further.
Yeah, so we had been much more dynamic over the last couple of years as far as trying to adjust that position, that protective position, the put options that are in the portfolio, and vary the position from what we had as like a delta position, where it's more at the money puts, to what we call our gamma position, which is further out of the money puts that may expire worthless, but at times, if you get a 50% drop in the market, for example, might contribute 2, 3 times to the portfolio, because you have a bigger position on because you bought them farther on the money at a lower cost. What we're doing today is just much more simplified in that regards. We're just really looking at purely protecting the downside, and now we're protecting the downside by about 50% coverage. So if the market's down 30, you're maybe down 15 or 20. And it's a very structured, fairly static position where we'll be buying quarterly expirations of put options and carrying those into expirations and just rolling them. So we're not trying to get clever on the protection side. We're just trying to be good. Just something that we know if the market drops 30%, we'll save it from 15 or 10 to 15% of that loss when that happens. We're not trying to make all the money on the put protection. We're just trying to smooth the returns so that over time you're recovering from higher levels and you can, because of that, compound at a higher rate over time.
So this is interesting. Let's dive into this a little bit further. I've talked to some wealth managers where when they are dropping, they almost like to harness those losses, and that's for offsetting taxes, etc. But basically, what you're saying is that hey, let's ride all the way down, but also let's have this other tool, this other vehicle that can obviously offset that instead of going down 100%. Now you're only going down 50% or whatever that may in your circumstance. You're going down 30%. It's only going down to 15, and we'll be able to bounce back up, and we don't have to harness that loss because now we've obviously leveraging this other vehicle that can harness that loss. Is that correct?
Yeah, yeah. So the return driver diversifier is intended to pay for the cost of put protection, and in a way, the losses get harvested because we're on quarterly expirations. Will have those going out a year. So there are periods where the market drops that 30%, and the option expires in the money. So we've harvested it, but we're not doing it in a market timing sense. We're not trying to say we think this, and we've looked at this in the past, and we've attempted this in the past, but it's very hit and miss whether or not you've found that bottom point now, and you should get out and harvest that. It could drop another 20, 30%, and now you're not as protected as you should have been. So our philosophy is to keep the same protection on all the time, but to have that sort of laddered in so that quarterly we've got these rolls that are occurring that may be in the money at the time they expire, and so essentially they've harvested. But we're not trying to get too clever and either predict that or time that in the marketplace, because that's what we're actually playing against, I think, in a lot of what we do with this is the emotions of the crowd and the fact that there are other people trying to take those bets. And the market's selling off, they start to panic, they sell it off further. Maybe they take profits there or they don't, but what we talked about early on in this conversation is that behavior tends to be wrong, and we try to play against that behavior. I have a chapter in my book, and I show in there the Dalbar studies that show that investors underperform the very funds into which they invest by as much as 5% per year. Very consistent behavior. This goes back decades, and it just stays the same decade after decade after decade. People will mistime the market. We don't want to be one of them. We want to be capturing that return that they're providing to us, essentially.
So let me ask you this. Let's take a kind of a case study or a situation. So because the reason why I love this kind of approach is because it's a very defensible model, right? Definitely in this tumultuous times where people are seeing there some individuals, some of our audience members are sitting in cash and they're waiting for those opportunities, right? They understand, hey, when there's blood in the streets, that kind of concept, we're going to go ahead and take advantage. However, though, let's say 12 months, ABC company that was trading at $20. Now it's trading at $10. However, though, the market still may go down. It may go down to $5. Well, they buy it at $10. Well, they now all of a sudden do they just embrace the loss of $5? Because now all of a sudden they buy 10,000 shares or whatever at $10, and all of a sudden that price goes all the way now to $5. That's a heavy loss. But you also understand you're playing the long game, 12, 24, maybe 36 months down the road. It may jump back up to 25, 26. So what you're saying in that term, that time frame, you're going to buy some put options to be able to say, hey, you know what? At this circumstance, at this number, where it's not going to go all the way down to 5 in this circumstance, but the percentage wise, because now all of a sudden you got other vehicles that are able to mitigate that. I just want to make sure I'm understanding that process. And so
that is what's happening.
Okay. Yeah.
Yeah, correct. So, but with us, we're not looking at the individual equities. We're looking at the indexes. So we've got 10 funds we've launched for 401k pension plans, qualified plans right now. They're set up as collective investment trusts, and that gives you large cap value, large cap growth, large cap blend, small cap, mids. We've got some fixed income, international. So people can kind of create a diversified portfolio, but using these protected products. And the idea is that if the market's dropping, from 10 to 5 or whatever you're using the example there, is that the put options that are in there are protecting that downside. And if it's happening over the course of the year, and we've got quarterly expirations of this protection that's in there, some of that protection's rolling off in the money, and we're collecting the profit on that, which is lowering the loss on this portfolio. The whole idea is to get away from any kind of market timing and saying, hey, it dropped from 10 to 5. Should I get out now? Should I buy more? I mean, it's really a coin toss in a lot of cases. We're just sitting there saying, no, no, we just maintain that position and we keep rolling our protection. And so if it drops from 5 to 2.5, well, we had the same type of protection you had when it went from 10 to 5. If it goes from 5 to 10, we've got the same protection on there that was on there when it was at 10 and maybe would have gone to 15 or 20, but it didn't. So we're not trying to be clever with it. The difference is we have that protection in there. It's rolling every quarter, and it's the cost of that is being paid for by the return driver diversifier over time. So if you end up with no cost protection over time, and you're lowering your losses, what you've done is you've increased the slope of your returns because you're smoothing the returns and recovering from higher levels. That's the simple statistics behind it. It has to be a very disciplined approach to work. You can't be sitting there trying to market time, catch the bottom. Um, I had someone and there's a lot of anchoring bias. I had someone this past summer who said, "Hey, I think Tesla's a great buy here. It's come down 30%." And my comment to him, this was over at a golf thing outing we were at for our kids that I won in Special Olympics, and we were Special Olympics, and I was talking to her about this, and I said, well, just because it's come down doesn't mean it's cheap. You still got Tesla valued at the next 10 auto companies combined. So think of it like that. It could drop another 50% and still not be cheap. And she just had a hard time grasping that, because that seemed like a great place to buy it. What we're saying is don't even think like that. Don't even worry about that. Just put your money in the indexes, like has been preached, buy and hold, but protect it. And that's why we refer to these products actually as a smarter way to buy and hold.
Well, this is a very, very powerful solution. I really appreciate it because, like you mentioned, nobody can anticipate when the bottom is. And I remember right before, prior to COVID, when the stock market was really tanking, I bought some stocks because I knew at some point it was going to return, and I'm young enough where I could anticipate the risk. However, though, I bought some things and it went down 4 or 5 or 6 or 7 or sometimes $10 still, and so that was pretty tough to watch. However, though, I knew long term it wasn't like I needed the money, etc. But I love this approach because that really is a defensible model, because what we're seeing right now is we're seeing some stuff available, but I think a lot of individuals are saying, okay, when should I buy? And this is a really good defensible model where it's like, hey, I can bounce into it and not, ensure that I'm mitigating that risk. Mike, I'm curious,
Yeah.
where did you come up with this idea, this kind of concept or this solution during your journey of five, many years in this industry?
Right. So everything is based on prior knowledge and accumulated, learning. And so this isn't the type of thing that even if it was shoved in my face 40 years ago, I probably would have innovated because I didn't have the baseline knowledge to be able to do that. But we were engaged about 5 years ago by a family office that had a large exposure to, it's a hedge fund manager, but it wasn't, they were really long equity manager with some hedging to it. And they were looking for a way to protect that position in their portfolio. They didn't want to exit it, but they didn't want it to be wagging the tail wagging the dog, the entire portfolio. So um, I started looking at some of the ways that people were doing that, and I kind of dug into our background and started realizing we had all the tools we needed between what we've done with the futures markets and as a CTA and different things over the years with managed futures and the options experience that we had and equity trading that we've done to put together a product that sort of is a synthesis of these three components. So it was kind of one of those aha moments when you look back on it, you realize, well, that was pretty simple. Why didn't I think about this years ago? It's so obvious. But it wasn't one until I was kind of faced with that problem and realized we had the tools that we developed. But it was, yeah, it's just a natural process, I think, that just required that expertise, sort of experiences to be able to synthesize.
That's awesome, man. And it's just so fun how sometimes you put these constraints on your own self and say, okay, well, that's a good question. Let's find the solution behind it. And you figure out this incredible thing. And now you're applying it to so many people, some of your clients' accounts. I'm curious, because I was just thinking about this as you were talking. Let's say, for example, my example, and I know you mainly focus on hedge fund indexes, but I like to just keep it simple for our audience. So let's say that it does go down to $5, in this case scenario. Then all of a sudden you start seeing, right? Maybe 18, 22 months down the road, it starts going up to 11, 12, $14, et cetera, going back up to that prime of 20, $22, et cetera, per share. In your put, do you have some sort of, stop loss, if you will, that says, hey, once it reaches this, we're going to go ahead and turn that off? What does that look like?
Yep, we don't. So once again, we don't want to try to be too clever. We try to keep it as simple as possible, and we realize that there's going to be puts that are going to be expiring worthless in a bull market. And if we have 50% protection in the portfolio, those puts are going to be costing us, say, 3 to 4% even per year. That's where the return driver diversifier comes in. That's structured to return over time that 3 to 4% per year. So it's intended to pay for the cost of that put in those bull markets. It won't happen every year. There'll be years where we lag because the puts expire worthless and we actually lose money on the return driver diversifier. But on average, over time, if we're able to match the cost of the puts by earnings in the return driver diversifier, we'll earn the underlying beta index, S&P 500, EFA, whatever that is, during a bull market. And that's all we're trying to do. We're not trying to outperform a bull market. We're trying to match, because what we do, and we know the math is on our side, that when there's a bear market, the puts will add value, and we'll be collecting premium off those that we not premium, but we'll be collecting the earnings on those as they gain in value as the long put exposure we hold goes up in value when the market drops. So if we can do that and we can keep a bull market performance matched, but then recover from something that's down 10 or 15% instead of 25 or 30, you end up earning greater returns over time. So it's somewhat counterintuitive that reduced risk equals increased returns, but that's the math on it. That's how it works.
Incredible, incredible. I appreciate you bringing this strategy up because I don't think there's a lot of individuals that, I've never heard of this strategy, and I do realize
No.
the power behind this. Mike, I want to dive in a little bit further. What other strategies do you feel like a lot of individuals are, for a lot of my audience, because you work with a lot of high net worth, ultra high net worth individuals, and you're kind of getting a little bit more mainstream where you're giving a lot of these resources, these vehicles to these individuals that may or may not have had access to it, which is nice. So what other strategies or tactics have you noticed from your years of experience that a lot of people are not leveraging or utilizing in their portfolio management?
Yeah, so we've got a fund, uh, Marco Polo Stewardship Fund, that we set up for a family office client, and they've helped guide us on where they want the fund to be for their assets that they initially seeded the fund with. And it's very diverse. If you look at it, the fund is designed to be sort of have core holdings for preservation of capital with some convexity kind of optionality trades that might make up a fifth or a quarter of the portfolio. And so in the core position, and you just don't see a lot of people maybe doing as much as they should in even the core positions, but it's got uh, some inflation type hedges in there, but it's also got a variety of strategies trading diverse global markets. So more of a managed futures kind of approach to things, where it's got seasonal strategies trading in the grain markets. It's got some behavioral strategies, they're trading in fixed income. So it's a variety of strategies in the portfolio. It's not just own the S&P and walk away. And this is what I talk about a lot in Jackass Investing, is that I don't have a problem. I think the return drivers are valid underlying the stock market. And I think it's going to go up over time in the US. But do I want to bet everything on that? And especially when you run into sequence of return risk, what if I'm in a position where now I have to start withdrawing some of that money and we hit a period like the 2000s, where it's damaging to my portfolio. So by diversifying into these global strategies, global markets, it just adds tremendous portfolio diversification. I don't see people employing that in any significant way at all, and I think it's a big miss in their portfolios.
See, this is interesting conversation here, and I'm glad we're getting a little micro with this because I literally just got off of a conference early December before Christmas, and they were talking about how, and this has been a lot of conversation behind this, where a lot of, you know, most individuals, we've all heard that 60-40 split in your wealth management, right? 60% in some sort of, growth, and then 40% in some sort of whatever in preservation. And now there's a little bit more in, like, 60-20-20, where some of that is going into alternative investing, or like you mentioned, emerging markets, right? Global markets. Mike, I want to ask in regards to kind of what that looks like in regards to alternative investing, but also global markets, emerging markets. What are some markets that you're kind of maybe sharing with your clients that you're like, hey, let's keep an eye on some of these funds or some of these indexes that are invested into these emerging markets, because there are some very exciting things that are happening outside the U.S. Again, U.S. has really had some amazing runs, and I think they still have a massive growth. But it's smart for a lot of investors to start looking at that. So, what are you noticing globally at a macro level?
Okay, yeah. So let me answer two steps first. We published a white paper 2 years ago now, showing what we thought, just based on math and statistics, what the return would be on a 60-40 portfolio through the 2020s. And it was low single digits, because you're starting with the 40 portion of that at 1% or so, a low number on the fixed income side. And stocks, by a lot of traditional metrics, were overvalued. Profit margins were high, price earnings ratios were high. There were a lot of reasons why, if things just sort of went back to long-term normal ranges, you'd be eking out a couple percent return annualized over that period. So we don't, the kind of where are we looking? What do we see? We take the approach, and I talk about this in the book too, but it's return driver investing is really trying to understand the underlying return driver for each investment you're getting into, and not investing by I'm going to be 60% stocks, 40% bonds, because there are periods like we just saw where that doesn't provide any diversification value. Um, but if you really kind of look at underlying return drivers and you put strategies in your portfolio that are diverse from other strategies, you can create a truly diversified portfolio. And that's what I kind of just alluded to a few minutes ago. If you have strategies in the portfolio that are seasonally based, trading in grain markets, you're going to get an entirely different return profile from that than if you're looking at a momentum strategy trading in stocks. And they're both valid approaches. They each are valid return drivers that over time will provide an intrinsic return. There's a logical underpinning to strategies, these various strategies. And so what we always try to do is, instead of individually say, hey, you guys should be in this or you should be in that, we create a product that combines these different strategies that they can go into. Because too many of them are too difficult for people to individually try to exploit these return drivers on their own. It's just generally too complex. And so what you'll see is people aren't using them because of that. But often the best strategies are the ones that are underutilized. And so we create products like our Marco Polo Stewardship Fund that people can invest into as a family office, that gives them this broad diversification in one bucket.
That is incredible. That is incredible because, like, I get where you're coming from. Instead of getting micro with every single one, you say, let's put all these together, and then overall you'll have some winners, you have some losers, but also it kind of mitigates it. And obviously you'll have more winners, of course, and then obviously it offsets everything else. I'm curious, just with those funds, could you just mention maybe some of the rate of returns on those, just for our audience to hear that?
We're really not allowed to do that
Okay,
here,
no
but
worries, no
what,
worries.
I can tell you, yeah, what we're targeting on those are, above a diversified in that fund, for example, above what a diversified, traditionally diversified portfolio would be, but with less risk. And again, it's just the statistics on it are if you're more broadly diversified, you reduce the risk, and that allows you to increase slope over time.
That makes perfect sense. Awesome, awesome. I want to ask a little bit further, and I appreciate you saying that. So, for those that want to learn a little bit more in regards to kind of the funds approach, I'm just going to put down brandywine.com. That is his website, so you guys can learn a little bit more. Can reach out to his team, etc. So, I want to make sure I put that in there real quick. I want to loop in a little bit further, Mike, excuse me, where we're talking a little bit about the alternative investing and specifically kind of making sure that these high net worth, ultra high net worth, as well as Main Street, we're able to offset it with. You mentioned something, preservation versus growth. Okay. And I want to talk a little bit about this because we're seeing, and I've talked to a lot of my friends where it's, you got the interest rates, you got taxation, you've got a lot of these things that are really eating up your money. So you got to now focus a little bit now, not on just preservation, but you got to have some growth strategies. Do you recommend, and like you were talking a little bit about, where you've taken like a fifth, like that 60-40 split, now it's 60-20-20. Do you maybe even take a fifth of that and say, hey, I'm going to get really aggressive and maybe go in the VC world and say, hey, maybe there's billion-dollar valuations, et cetera. Like, what are certain growth strategies that you highly recommend? We were talking about defensible models, which is awesome, but certain things to be a little bit more aggressive during this time and saying, hey, you know what, these are vehicles that could really produce incredible returns. Now you could lose everything, but it's not like the money that you need for tomorrow to buy your eggs or anything. You need to, put that money on
Hmm.
to something that's obviously producing something long term that you can lose potentially, but also gain a lot. Um, what what are you looking at in regards to sharing that with your clients, etc.
Yeah. So when we look at it, saying it's 80% sort of preservation, making sure, and preservation doesn't mean putting your money in cash so you don't lose it, because you're losing money if it's in cash. And this is something I've had this discussion with investors many times in the past who say, I'm conservative, I don't want to lose anything, I put it in cash. And in the last year, you could say, okay, so you just guaranteed, I don't know, 8% loss, to inflation. So everything's a risk. Every decision's a risk, and it's all a trade-off on that risk. So when we're talking about that preservation part, it's trying to maintain value, purchasing value of that money that you put in there over time. The other portion of it, and where you're talking about the growth, and we really refer to it more of like an optionality or convexity kind of portion of the portfolio, where that small portion can make it big. Um, that goes into things like we actually have um, option strategies in there that are highly convex, where we'll put in a position that's it's almost no cost. We're risking some basis points on it, but has the potential. And if you look back historically, that maybe every 10 years that position itself might return 5 or 10% to the portfolio. Just huge convexity in it. And you spread that around a number of different bets. In any given year, they might all expire worthless. You lose a percent or so, whatever your risk on that. But then there are periods where a couple of them hit, and you have these bang up years. I as a side related to that, you look at things like crypto. And I'm always somewhat amused by people in today, with Bitcoin, say, 21,000, down from 69. People saying, well, I've never recommended it to my investors. I've kept them out of it. And I'm thinking, I don't know if I brag about that when it went from pennies to $21,000 in value. You're just saying that you totally missed this huge convex trade, which I'll have to admit, I was looking at in 2013, and we actually did some mining through the teens, but on a small scale, I, I missed it. I mean, I didn't see that this, when it was at $200, was going to be 100 times that in less than 10 years. But there are positions like that out there that you want to take flyers on. You put a little in there because you don't need to make a lot on them for it to work out for you. Um, Venture capital is some areas for that, but for most investors, it's just there's no way they should do that directly. Investing in friends and families rounds with startup companies. Yeah, it can happen every now and then, but I think it's usually pretty difficult, and they don't have the tools to evaluate it. But you want to have probably about 20% of your portfolio geared towards those highly convex opportunities.
What is your opinion right now? Because the VC and the PE world, I got a few friends in there, and I'm in that world as well. And it's so interesting how there was such mass amount of capital. Like anybody that was raising capital could raise capital. There was just so much, so much money being deployed towards a lot of these things that were not really, and the valuations were out the roof and whatever. Right now, things have cooled down, which is good. What are you seeing in regards to that? I know you just mentioned a little bit of the VC world where you just have that right mindset. Again, knowing the metrics, 80% of them won't actually produce anything. Portion of them will get to $1 billion valuation, the unicorn, and that will offset everything else, right? It's that kind of spray or pray approach that kind of Peter Thiel talks about. But obviously, making sure that really, I guess just your perspective on kind of where that market's at right now. We are seeing it cool down. We do know private equity, alternative investing, out of all the alternative investing, places that outperforms all the other alternative investing kind of verticals, private equity specifically. But I just want to get your perspective on that. What are you seeing? Anything that you recommend with your clients? Making sure, hey, let's sit off the sideline for now. Let's let everything cool down, or like you mentioned, still, hey, let's go ahead and deploy some money, but just have the right mindset and just say, only a very small percentage. And like you said, portion of that money goes towards preservation.
Well, there's always opportunities, and sometimes the best opportunities are in the worst environments. And I think opportunities still are there today, for sure. One of the issues that I do see is that so much money's gone in to these funds that is still to be deployed. So I don't think you're going to see a dramatic drop in valuations that people are paying, like maybe we have in some of the other, sell-off periods, just because there's still so much money that needs to be put to work, that's out there. And we're still seeing, I don't think on the smallest end, the startup end, we've had as big a drop as we had in some of the more sort of unicorn type companies that have come down in value. On the pure startup end, where somebody's trying to raise $1 million, a friends and family round or an initial seed round, those haven't had maybe the same impact, but they're the true convexity plays. It's not going into a unicorn trying to make 50% or 60% when it does an IPO, that I would consider to be in that 20% bucket. It's truly the ones where you go into and spray and pray, that has worked for so many people in Silicon Valley over the last 20 years now, 25, 30 years now, easily. It's just very difficult for any individual to be able to get access or to understand the value in those different companies to be able to make those investments. It's not. I think that's the most interesting sort of convex part of the market, but it's also the most difficult for an individual to gain access to directly.
Yeah, because I was talking to a friend of mine. He's the CEO of InvestX, and he's in the private equity world, alternative investing stuff. And a lot. There's been a very few IPOs recently. From a few years ago, it's really dropped down drastically. I don't know. Do you think, Mike, just on a personal note, do you think that's going to ramp back up a little bit and getting access to capital because the private market's not so much, or do you think because there are certain SEC guidelines that have kind of definitely with accredited investor, it's kind of liberalized a little bit where more Main Street are able to get access to it in different kind of criteria. They still have to meet that criteria. What are you seeing in the IPO market? You see like that's still going to be a big player, or you think it's going to stay at this kind of slower trajectory? Not as many companies are IPOing because they're staying private longer.
It's just it goes with the emotions, right? So it's one of the more behaviorally based aspects of finance is IPOs. If you've got the animal spirits roaring, you're going to see a lot of IPOs. If you don't, you won't. And I just think that'll continue. So right now, we're still in that non-roaring moment. Another year or two, there will be some segment of the market that starts getting heated up, like cannabis did, or crypto did, and or like back in my day with Spree.com, which is a company I had in the 90s, we did with all the internet companies, and you'll start seeing IPOs just come roaring out because it makes financial sense for the companies to do that, and the founders and the VCs and whoever backed them. So I don't see that there's any sort of long-term trend one way or another that's going to stymie that. I think right now, yeah, we're in a bit of a doldrums because the market is. People aren't willing to pay up for the animal spirits again, but that'll come around again.
Mike, for you being in this industry for almost 5 decades, and you've been up and down through 2008, 2001, .com, and now obviously this circumstance, whatever that's going to lead us down to. Mike, I would love to get your response, and I would imagine during your journey there are certain hurdles, failures that you had experienced, but you learned from those. Then you were able to build the right boundaries, the systems, analyzing that experience to say, okay, hey, how am I going to do better at this? If you could, I'd love to maybe just share some situation that happened, but then not only how you responded to it, but like how you analyzed it. What patterns, what boundaries did you put in play to ensure that you would not fall back into that hurdle? Because like what you're saying right now, I can tell from your experience, what you share with our audience thus far, it's all from just your, 5 decades of experience in this industry. You know where it's going to
Yeah.
go. There's no emotion to it. I know where it's going to happen. I've been through this as well. But I'd love for you to just share that with a little bit of our audience.
Yeah, so I wish I learned, like you say, oh, you have an experience and you learn from it. I can't tell you how many times I've repeated the same mistake, and I, I should be smarter than that. But and I realize it gets down to innate behavior and personality and things, and you need to protect against that. So from my standpoint, the one thing that I've learned repeatedly is develop a systematic process that you're going to follow, and as best you can, you stay with that. You don't let the day-to-day fluctuations or even year-to-year sort of change the mood of the market. What's hot. Change your overall structure that you're going to be following with your investing. And so right now, I mean, that's what's guiding what we're doing with these protected products. Is we started out with a pretty simple approach to it. Um, we started looking at ways to improve on that with more dynamic hedging, with dynamic harvesting approaches and things like that, that just haven't been productive. It really gets back to, what we have with these 10 products now, these 10 CITs, is a very pure, fairly straightforward approach that can be followed systematically. Um, Low complexities, not looking at adding degrees of freedom and timing a market to harvest it here or to, take better advantage because we think there's more protection needed now. All that complexity, adding degrees of freedom, reduces the predictability of your results and lowers your probability of having great returns over time. So really simplify, um, structure it as well as you possibly can to be sort of an automated process, and then just adhere to that.
Do you? And I love this approach because I'm a big believer in that, and building the right boundaries and systems, even having accountability partners like yourself, right? Your certified financial planner, wealth manager, et cetera, that keeps that person, your clients, accountable for that plan. Do you have contingencies? Like, when something like if this happens, I look at this as the same thing with like a business, right? We always plan for the future, but it's like, hey, we also have to plan for the worst case. If this happens, if all of a sudden this goes up, if we lose this big client, how are we going to? What is our plan of action? So it's not like you're running on emotion and you're making emotional based decisions. It's very logically based and say, okay, well, if this happens, then we're going to go ahead and do this, and we're going to adjust this. I look at this and the reason why I'm saying this is in the VC or the PE world, where a lot of times when you start seeing something, it's that concept like we don't want to harness our loss. And so if we see a company like just, folding and going bankrupt or like not being able to actually produce, definitely in the VC world, you want to say, okay, I'm going to write another $1 million check. I'm going to write another 2 million because I want to keep this thing going because I believe in it. I believe in the service. I believe in the founder. But also you have to say, hey, you know what? I'm going to go ahead and just, rip the bullet, umbilical cord. It hurts. It's painful, but I put a boundary and say, I'm only going to invest X amount of time, energy, whatever it may be. So it's the same thing, contingency plans for these investment strategies. So I just want to get your response on that, Mike.
Yeah, so you can't plan for everything, you just don't know. But as you get more and more experience, you can plan for more and more contingencies. And so we have sort of plans for everything we think we know today. But we don't know what we don't know. And so obviously we can't plan for that specifically. But yeah, for the most part, it gets down to when we're looking at like at the individual strategy level of things that we're trading in a portfolio is not, it doesn't get down to is it making money or losing money. It's is the return driver still valid? Because there'll be periods where you're employing a strategy and it just doesn't work. And it doesn't mean that it's not still valid. It just means that it's out of favor or whatever reason for that period of time. So that's the first thing that we want to do is we want to look at something that's not working and say, is the return driver still valid? And if it is, you just keep going with it. The other thing is in preparing for that is creating a balanced portfolio, so you're not dominated by any single return driver, any single action or event that could occur that could just destroy the portfolio. Um, in the end, though, if it's not working and you determine that the return driver is no longer valid, you just pull the plug. I mean, there's the best traders that I've ever seen are the ones that are able to just stop the burn, stop the loss, and move on from that. And that's really our whole philosophy. It's all about if you're protecting the downside, the upside definitely can and will take care of itself. So plan for as many contingencies as you can, but for the most part, just don't make those reactive decisions in the heat of the battle. They're almost always going to be wrong.
Yeah, I appreciate you sharing that, Mike, because one of the things that I always share with my audience, and I've mentioned this before, when I was like 18, 19, I was, trading stocks, and I'm not the best at it, was not at all, but one of the things I knew about myself is like putting a rule into play where it's like if I lost three trades in a row or even three in that day, I would walk away and I'd be done for trading. And that was a rule that I really try to stay disciplined with because I knew psychologically, like human behavior, I knew my psyche was not, I was, trying to get back, and I was trying to bet bigger, right? And that's what I would do, and I just knew my own limitations on that. So that's one of the reasons why I appreciate you sharing what you shared. And like you mentioned, I love the humility behind it. You can't plan for every contingency. There's 1,000 different, but really making sure that you do have some major plans and say, well, if this happens, cool, this is what we're going to be doing, this is how we're going to be adjusting, et cetera, et cetera. Mike, I really appreciate being on here. For those that want to obviously learn a little bit more about this strategy, these methodologies that you guys use, really mitigating and building that defensible model, which you kind of mentioned a little bit today. For those that want to, have that conversation with you or your team, what's the best way to reach out to you?
They can send an email off they can send it to me if they like, Mike at brandywine.com. I'll accept that. I'll respond to that, and we can move from there.
Awesome. And guys, I will put his email, and Mike, I really appreciate you making yourself so available. I'll put his email down there. I will also put his jackassinvesting.com down there, which is the book, and then brandywine.com, where you can actually get access to a little bit more of his resources and so forth down at the description below. I would highly recommend it. Again, one of the biggest things we are at A Journey with Christian Evans podcast. We focus on really making sure that we're always humble and we always want to learn and optimize our portfolio. So some of you guys are listening, you guys already have a really good established. Some of you guys don't, but you guys always feel like you guys have to have the right defensible model, the system optimizing it. And I believe you can always optimize by 1, 2, 3%, and that makes a world of difference. Mike, I really appreciate you being on here again. For 5 decades,
Thank
I've
you.
learned a lot just unpacking so much, and just I'm going to talk to my wealth manager and say, hey, are we doing this? Because you need to talk to Mike here.
Great.
But
I appreciate it. Yeah, thanks, Christian.
definitely. And Mike, before I let you go, I always love to ask my guest, is there any last words of wisdom they'd like to share with our audience?
Uh, no, I think, find what you like doing, as far as the wisdom, and stay with that. And if you're not enjoying what you're doing, find something different. But enjoy life as much as you can because it's not going to last forever.
Very well said. Very well said. That is the author of Jackass Investing. Don't do it, profit from it. And then CEO of Brandywine Asset Management, my friend, Mike Dever. Guys, that is Journey with Christian Evans podcast. Until next time, be uncommon if you can.
Thank you.